Hi guys, welcome to our weekly live event. So we go live every week, Sunday night on YouTube at 9 p.m. Eastern Time. We are a little late this week, about an hour, but kind of give you that notice that I was going to be a little behind. So the questions I answer is real estate related, finance, investments, retirement planning, taxes, credit, any of those questions or concerns that you have about your personal finances and want to get stuff in order, you want to grow and become stronger in any area, feel free to ask. I'm happy to help. A little bit about myself and my background. I have a finance degree, minor in mathematics. I got a second degree in accounting, minor in economics and international business. Now that doesn't really mean much, to be honest, without actual practical knowledge in the field. So I worked at Bank of America as a banker. I did loans, opened up accounts. I did anti-money laundering with Citigroup. I did auditing and tax with PricewaterhouseCoopers. It's a big four accounting firm. So I have a lot of real-world practical experience. I built my own real estate portfolio, an investment portfolio, have multiple financial businesses. So more than happy to give you this advice and help you grow yourselves. When you guys are ready, feel free to drop your questions in the comment section and I'll be able to answer them. So to kind of start things off, whenever you're investing in real estate or in any other way, things don't always go as planned and there's hiccups. Basically, what you're paid for is to be able to deal with those problems when they arise. So one guy was supposed to go out to my 5-unit property, didn't show. Another person was going to my first property I ever bought. It's a duplex, and I'm actually selling that now. Works out really well. I'm going to make like $100,000 on that sale, but there's a couple things that need to be fixed before I sell it. He didn't show. So, and then in addition, right now I'm working on the property I bought. It's 9 units that I'm converting over to about 16 unit property for Airbnb. So as you can see, I have all these things going on in addition to my companies, and my job is, which is also going to be your job, is to resolve these issues as they come up, because that's really what you're paid for. You're paid for being able to solve problems and come up with solutions in difficult situations. And it works out pretty well, So you're going to be paid more and more depending on the difficulty of the situation. So, for example, in the sense of, say, Amazon. Amazon resolves a lot of small problems, but they resolve many small problems that ends up that's what they make their money on. Lots of small transactions, saving people time consistently, helping them remember to get the orders to their house consistently by setting up like auto deliver. And by solving those problems, convenience and so on, they're getting paid for that. Now, there's another situation, another extreme example would be like a brain surgeon. They don't work off volume, they work off of the specific difficulty. There's only a few brain surgeons in the world that are very good, and when you have a problem, you need to go see one of them, and that's why they get paid a significant amount of money per surgery. I knew somebody that had to have a brain surgery, and their bill was like $300,000 just for that one surgery. So not even continuing expenses. So you can see, depending on the difficulty, you're going to be compensated. Another example is with me, I have a lot of rental properties. So for the basic rental properties that are blue collar, you don't make a crazy amount of money, but you bring in consistent money to yourself for your retirement or for you to live off of. So on my blue collar properties, I'm just consistently bringing money for a more convenience factor in someone's life. Now, for the properties that are more Airbnb and the ones that actually another example would be my flipping. When I flip a property, that's usually something that's more of a heavy lift. There's a lot of work that usually needs to get done, a lot of detail. And because of that, I make a large chunk of money one time. So because it's a more difficult thing that a lot of people don't want to take on, I get paid more money to resolve those issues. So those are the differences in finding problems and being a problem solver. Now, a really good question is, how do I know how to solve these problems? How do I know when am I going to need this skill set, right? So, or what skill sets actually? The question would be more like, what skill sets do I need? And that's the thing, is the more you learn, the more little skills you learn, the more it adds up to be able to help you solve more problems in the future. So I learned the finance aspect of the game. I learned the credit aspect of the game. I learned how to be more conservative to save up my money. I learned the construction side of it, how to fix things. So because I know all these little parts of it, all of that adds up to me being able to resolve problems when they come up. So, excuse me for the noise. So, excuse all those people that are very loud outside. They're also known as my friends. So, again, feel free to ask the questions, Cedric. Yes, I do understand that, but that's how it starts. You start like this. You start, not a lot of people watching, but at the end, this video actually goes onto YouTube, and then usually a few hundred people will end up seeing it, and sometimes even more. So it's not just for teaching the lesson now to the few people that are watching, but also for the future people that are going to watch later. I have about 103,000 people that follow me on Instagram. So I also let them know, hey, I put out the recording, I put it on YouTube, and then they can go and watch the videos because not everybody's available this time of night. So it's really only for the people that are able to come on right now. And normally I put it on 9 p.m. Today's what, 10 p.m.? 10 p.m. So it's not the normal time, so it's a little bit less. Okay, 1 second. Let me go up to the questions that I had from online. All right. All right. Thanks for your patience. Again, if you have any questions, put up on the side. I'm actually looking up on the questions that I was asked. So it says, for one of the questions says, what advice would you give your 20-year-old self? So that question, I would say, don't worry about seeing instantaneous results. So the results come over time. So right now the results kind of come over time. You can't really control when you're going to get the results. So again, like you mentioned a few minutes ago, there's not that many people watching right now. When I started, there's nobody watching you. There's no one cheering you on. Most people are going to think you're not going to be able to do it, and they're going to be naysayers. So what you're going to do is consistently put in the work. And what happens is now, it's been almost 15 years that I've been doing this. I'm getting the results now from my hard work that I put in back then. Back then is what I'm reaping the benefits of now. Right now, I'm building that new complex, it cost me about 1.3 million. So the results and all the money I'm going to get in a few years are from the work I'm doing today. So if I just say, you know what, it's not worth it, I'm going to give up, no one believes in me or whatever, then you're not going to get the benefits in years from now, where you're going to be kicking yourself, like, man, I really should have done this. So like back, 10 years ago, I was like, I really got to get on YouTube, I got to do it. And this is the one part of my life that I did listen to the naysayers and I didn't start putting up videos. And if I did, obviously 10 years ago, I'd be big right now, or bigger right now. And so that's that one part where I actually listen to somebody and obviously I don't get the benefits from that. But you're always going to have haters telling you, no, you can't do it or whatever. And you're just going to have to put in the work either way. So Jake asked the question, Jake says, how do you think the real estate market will be in a few years? So I think in a few years, probably in about a year and a half, 2 years, we're going to have a correction in the market. I'm not saying there's going to be like a recession or anything like that, but it's going to be a correction. So what does that mean? Right now we are above average in employment. So the key goal of our key goal for employment rate, I think, is like 4% unemployed. Right now we have a 3% unemployment rate. And at 3% unemployment rate, this year, 70% of the population cannot afford a $400 emergency. Last year, 50% of the market couldn't handle a $500 emergency. So what that means is more people cannot handle an emergency or something that pops up for a very small amount of money. So what it means is that when we go back to, say, normal unemployment, which is, or the goal unemployment is what, 4%? Well, right now we have 3%. We don't have enough money in the country. Go down to 4. It's going to be even worse. Less people are working, less money in the market. It's going to cause things to go down. And then if we even go, say, 6% unemployment, which is not horrible, it's going to make things get even worse. Now you add that into the fact that most people are using debt to spend even more, going to be even worse. So what's going to happen? The market's going to start slowing down, which is going to cause stock prices to go down, housing prices to go down. Is it going to be a recession? I do not think it's going to be like end of the world recession. Do I think it's going to be like 10, 15% going down in prices? Yes, I do think that. But where if you buy deals now, and I'm still buying deals now, but I'm buying them in the type of deals that even if it does go down, it won't matter. I'm bringing in enough money that it really makes sense, and that it's a lot of value for the amount of money that if it goes down, it won't matter, and that the rents are so good that I'm going to be making money anyway. So the good thing is this is a long-term play. This is not like, the real estate game. You can play many different ways. You don't have to, say, flip the stock and do day trading with it. You can buy it for a 2, 3, 5, 10-year period, and your goal could be making your money in 5 to 10 years, which most of the deals I do, like this most recent deal I told you about, the large Airbnb complex, that one is going to be at least 3 years for me to hit to start maxing out my income possibility of it. So I'd at least want to wait 3 years before I would sell it. And then after I do that, I probably want to wait from once I hit the peak, I'll probably want to wait at least another 2 more years. So I have about 3 years of financial showing, like, look how much money this place makes. So by doing that, it'll be easier to sell. I'll be able to get a lot of money on the sale. And I can still collect money. So when everyone's struggling with bringing in cash flow, I still have an amazing property bringing in a ton of money. I mean, at peak full occupancy, I'll probably be bringing in around like 45,000, at least $45,000 a month. Like, think about that, $45,000 a month. So as an Airbnb property, so it's definitely an awesome deal, especially since I put in like 450,000. So I'm making back my money each year, 100% return on investment. It's awesome. So, and I'm going to be doing the BRRRR method. So I'm going to be doing a cash out refi later. So at that point, I'm probably going to be bringing in, like, even when times are tough, 100% return on my investment. So you got to be prepared for those things to happen. So in real estate, you can make money when the market's up, being flat, or going down. Your skill set that you learn, that you pick up from my pages, all those little tips I put out, that's the stuff that's going to be able to, put more tools in your tool belt. So when an opportunity comes up, you can find a way to make it profitable. Great question. If I buy a home with 20% down, can I sell the home after a year as the bank still owned more than 70% equity? Yes, you can. So at any point, you can buy a home, and after, let's just say it's 3 months, you change your mind and you want to leave. But you bought a great location, you got a great deal, and you can sell and make a lot of money. Or you bought it and, you fixed it up over that year and you made it go up 20% in value. You can turn around and sell it within a year. There is no rule that says you cannot do that. Now, You just have to be very smart and with your fees, because obviously every time you buy and sell, you're paying fees. But to the point, yes, you're gonna sell. Yes, you can take your profit. You bought a home for 100,000. You put in 20, so now it's 120 total. That includes your down payment and everything. It's now worth 150. You owe the bank 80. When you sell the home, the bank will get their 80,000 back, and you'll walk with the 70,000. But again, there is some fees that you have to pay out of the 70. So the point is, yes, you can sell at any time. There is no reason that you would have to hold it longer, and that's what flipping is. When you're flipping a property, you're buying it for the short term. You're gonna maybe upgrade it, maybe you're not, and then you're gonna sell it for more money. So, yeah, definitely a good. It's a good opportunity when you find the right deal. And each way, there's many different ways you can make money in real estate by the deal. The deal will determine if you're going to hold it, if you're going to flip it, and so on. The next really important thing about the real estate specifically is, in actually any type of investing, you want to know your market. You want to understand it. Like Warren Buffett says, he doesn't buy tech companies. He's like, I don't buy anything I don't understand. Now, even though Warren Buffett's very good friends with Bill Gates, he still doesn't buy any tech companies. So you can see that he wants to know it very, very well before spending any money in that thing. So you should know it very well as well when you're looking to invest in something. So you know it well. Next question we have from Jake says, do you think Airbnb is really going up right now, or do you think one should? Yes. Regarding Airbnb, when I say Airbnb, I'm only using that name because that's the popular name. So, when I say Airbnb, I'm talking about short-term rentals. Short-term rentals is usually, by the government, is labeled as like less than 7 months of stay. So if you rent a property out for 6 months, that's a short-term rental. 3 months, short-term rental. 1 month, 1 week, 2-3 days. Those are different types and different markets of short-term rentals. So whenever you do a short-term rental, you take on more risk, and you will charge more money for the higher risk you're taking on. So that's good. You know what I mean? Like, if it's the right market, because not everywhere should be. I've ran numbers, and very few places are good Airbnbs. And normally they'll make more money as an annual rental, and it's less headache. So you definitely need to run your numbers to see, is it worth it? Am I going to make more money? So don't just think Airbnb, make more money. No, you have to run your numbers to see if it's worth it. Because if, for example, really simple, if you're going to rent a place out for $1,000 a month as an annual rental, you don't furnish it, you don't pay electric, you don't pay cable, you don't pay any of those expenses, and they're rented for the full year, and it's unlikely the person's going to leave during that year. And normally, we'll stay for a few years at your place. If it's an Airbnb, many places only have an occupancy rate of around 50%. That means half of the year, it is empty. So let's make believe your Airbnb brings you $2,000 a month as a short-term rental. It does, a short-term rental will bring you, say, let's just say, in this example, say $2,000 a month. Well, in a year, as a long-term rental, you bring $12,000 in revenue. As a short-term rental, it's only half full. In this example, it's only bringing you in $12,000 in that year. So you now have a property that you brought in the same amount of money as a long-term rental, but it is furnished. You have to constantly work with new tenants to move in and out. You have to constantly get it cleaned. You have to pay electric and cable. So at the end of the day, it costs you more time, and you brought in less money because your expenses are higher. That is a normal situation for most places in the country. So you have to be very specific about where you're going to Airbnb or short-term rental, VRBO, home away. Doesn't matter what you want to call it. It's a short-term rental. So you have to be very careful on what you're going to do as a short-term rental to calculate, is the money there and worth it. For everyone that did the thumbs up, thank you. I appreciate it. That positiveness definitely helps encourage me. So to keep giving you guys good value. James says, but if I had a mortgage term of 25 years on a deal, can I still return all of the bank's money once after a year, though I had a 25-year term? the bank is taking a loss on interest of this happens. Don't ever depend alone on Airbnb. Your listing will be stopped if the roof went low. Go with Booking.com and see how your booking hits up. Greetings from Buffum from Vienna. So, James, in America, on a residential home loan, you can pay it off sooner than, say, a 30-year or 25-year term, and you don't get a penalty. On a commercial loan, there could be a penalty for that. So in your country, there might be a penalty. I can't confirm that or not because I don't do business in your country. Some countries do have a penalty. I know in Canada, there is a penalty if you get a loan that's 5 years and you don't keep it 5 years. There is an extra interest charge. Sometimes you should pay it. Like I have a commercial loan now that I have a penalty if I refinance sooner than the term we agreed. I'm considering doing it anyway because I'm just going to count it as a cost of doing business. Because if I can refinance and take out an extra $250,000, and my fee is say $5,000 for doing it sooner than it should, then I might say, you know what, paying $5,000 is worth it for me to get an extra $250 out of this deal. So you have to calculate: is it worth it for you? And regarding Booking.com is a good option, but from what I understand from Booking.com, they can charge 15 to 20% as a booking fee as well. So yes, it is another option. The one thing people seem to like about Airbnb is it's a more popular one, and at the same time, that from what I said, the fees in America, they're a lot lower than the other options. So I don't know how it is in Vienna, but yeah, you do bring up a good point. Hugo says, how do you find a good deal with good percent of equity? That is the $1,000,000 question, right? Because if you find good deals, that's all that matters, right? So normally when I tell people is this, it doesn't matter. Just find a deal and everything else usually will work out. Because if you find an amazing deal, you can bring it to an investor that you know is like a reputable person, and they'll probably buy it from you, cut you a percentage for finding the deal. They'll usually give you something for it because the hardest thing is to find a deal. Now, what do? I spend all year looking for deals, and then, once every 3 months, I might find something. And then when I do find it, I have to be very aggressive about putting in offers. So you can find good deals. It takes a lot of work and time. So that's what you get paid for too. So as I mentioned earlier in our videos, that you get paid for resolving problems, right? So finding the deal is a problem. If you can find a deal, there's a lot of investors out there they'll pay you well for helping them connect them. So like here, like there's some people that are not local to me, but they live a few hours away, and they follow me on Instagram. And they said, hey, I want to do something with you. I said, look, you got a few options. One, you can either find a deal, and I'll fund the deal, and I'll cut you in on the deal. Or if you don't have the money, or if you have the money but you don't have the time to find deals, put up some of the money, and I'll cut you in on the deal. And that's called syndicating, or that's called JVing, joint venturing in a deal, because sometimes you have money and you don't have a deal. Sometimes you have a deal and you don't have any money. And sometimes you have those two, but you don't have the skill set of remodeling or the connections to get it remodeled. So those are different players in the game. And everyone kind of could be good at one thing or another. So it's definitely important to team up with people. Great question, Hugo. So James has a question. How do refinance work? I have heard many times put down 20% on a good deal, force appreciation, and refinance from the bank after a year and take your down payment out from the deal after a year. How do I take down payment back after a year work? Very good question. Okay, so this is how it works. I'll give you an example how I did it on my second deal. On my second deal, I was able to put down just $8,000. So I bought it for $160,000, and I put down $8,000. Now, this way, how I did it through a line of credit. Okay, I didn't actually refinance. So I'm going to give you multiple ways of doing this. Bought the property, it's a duplex, $160,000. I put down 8%. That's 8,000, I fixed it up, increased the rents. After 6 months, I went back to the bank and I said I would like a second loan on the property. So I kept the first one and I got a second loan. The second loan was for $42,000. And why they gave me that money is when they went back and they appraised it again, they said, wow, the properties were so much more, we're willing to give you $42,000 more on this property. So now I have two loans. The original loan for about 150 something thousand, and then the second loan for 42,000. So took the money and I used that money to buy more real estate. That is one way of doing it, and that is the way you force appreciation. And after the reappraisal, they're going to say, okay, there's so much equity here, we're willing to give you more money. Second way, the more common way of doing it, the way you hear about it online, it's also known as a BRRRR method: buy, remodel, rent, refinance. You normally want to find something that is, when you're finished, has your purchase plus remodel is 70% of the cost of the property. So the example would be, you buy a place for $50,000. You put down the down payment, you then spend another $20,000 fixing it up. So you have your down payment money in plus $20,000 in your rehab. When you're done, your total between your down payment, your rehab, and the money owed to the bank is $70,000. The new appraised value, if it fits the model, should be $100,000. You go back to the bank and you say, look, the property's worth $100,000. I would like to refinance it. The bank's going to see, oh, okay, it's worth $100,000. We're willing to give you a loan of $70,000. First, they're going to pay off the first mortgage. That's going to be gone. Then they're going to give you back your money. Then the rest of the cash left over goes to your pocket. That's it. They're going to cut you a check for it, which is your remodel budget and your down payment amount. And if you do a really, really good job, you'll even walk away with extra cash in your hand above your down payment money and your remodel amount. So that's when you really, really do a good job. So that's called the BRRRR method, and that is something common. But what you're doing is you're finding something that's worth more than what its current position is. So it's currently beat up. You find it, you're going to fix it, you're going to be able to rent it for more money, and you're going to get that forced appreciation. Because remember, rental properties especially, are worth their value in the rental income they generate. So if you can increase rental income, you increase value. You increase value, increases the money you can pull out, or when you sell it, you're going to get more money. Quick tip. In a market that's like in Florida's market, every $100 you increase rent, forced appreciation amount is $15,000. So if you increase rent $100, you increased your resale price roughly $15,000. So it's really awesome. I'll usually get a duplex or a quadplex. I'll raise the rent $200, $300 a unit. And on a duplex, $200 a unit, that's $400 a month. That would give you an additional $60,000 in forced appreciation. And if you're good and you could do that within the first year of ownership, you can refi at the end of the year. And that's a really easy way to refi and get your cash back on the deal. Great question. So next question is from, so then James had a follow-up, says, do every bank approve refinance or the bank I got a mortgage? You would basically reshop it like it's brand new. You can go back to the same bank you used before, or you can go to a brand new bank. It doesn't matter. In America, it will not matter. You can go to anyone you want. Now, sometimes if there is a bank that charges you a fee for refining early, which is extremely rare in America, you can sometimes go back to them and have them do the refi, and then normally their penalty will be a lot less because you are doing the refi, but you're giving the business back to them. So they're normally be like, you know what, we'll charge you less of a fee since you're going to give the business back to us. Jake's question is, I saw a video on how to live rent-free by buying a duplex, renting out the one side, having roommates pay for your part, and do you think this is a good idea? So Jake, this is what I did. Sorry. So that's what I did. And I actually have videos on Instagram, and actually on my YouTube channel, I got a few videos talking about this concept. So I bought a duplex. I stayed on one side as I was remodeling the property and had the other one rented out. The rent from that one side basically covered all of my mortgage, taxes, and insurance. So basically living rent-free. That way is a great way for you to be able to live rent-free. And then I didn't have a roommate, but if I had a roommate, I could even made money because I had an extra room in my on my side because it was two bedroom. Excuse me, it was 2 bedroom, 1 bathroom each side of the duplex. So yeah, I could, that's definitely a great way to do it. James says, if I sell a deal, do I have to pay taxes or the buyer will have to pay the taxes? Or both sides have to pay the taxes? So James, what type of taxes are you talking about? Are you referring to property taxes or are you referring to sales tax? Property tax, you only pay property tax for the period of time that you own the property. So if you own the property for only 2 months, you would pay for 2 months worth of property taxes out of the year. Another person would pay the rest. So you'll see when you buy a property, the person that you bought it from, say you bought a property in November, right? The person that you bought it from is going to give you a credit of 10 months worth of property taxes. So at the closing table on your documents, it's going to show that they gave you 10 months worth of property taxes, basically giving you the money so you can pay it when the tax bill comes. So that is that's what normal happens. You're not stuck with the whole year's property tax bill. Again, thanks guys for all the thumbs ups and the likes. I appreciate it. Hugo says, do you think it is worth it to go to college if you want to play the real estate game? It is not necessary for you to go to college for you to be successful in real estate, right? It's not necessary. Now, what is necessary is for you to get some good mentors. You get in the game, you start talking to a lot of people, and you learn. That is how it's done, right? Like I went to college, got lots of degrees and so on, and they gave me a good understanding and background of certain things in finance and in accounting, but not like that makes you successful in real estate. That is your lifelong learning skills that come into play to make you successful. So getting in with the right people, getting the right mentors, and then picking up what they're telling you is what's important. So if you're going to go to college and you want to be a lawyer, a real estate lawyer, right? Yes, that would be important. You'd need to go to college. But going to college just for marketing, I don't think is necessary. You would have to go for something really specific, right? If you wanted to be an architect or an engineer, yeah, you need to go to college. Otherwise, it's not important. Good question. Again, guys, whatever questions you have, put it in the right side. You guys are kind of lucky because there's not a lot of people on today, so you guys can ask a lot of questions and get them answered. A lot of times actually almost all the time on my IG lives, there's so many questions that come in, I'll only be able to answer like 1 or 2% of the questions. So let's see what questions are on here. All right. We'll pull up the questions. questions are very long, so let me get. Congratulations on your success. Now I'm. Okay. I'm only 17 years old. I do this although my limited limits company has 500,000 euros. Right, this question is too much. So James asks, can you teach some script you use when you meet sellers? Honestly, I don't have a script. I'll be honest with you. What I would say is this: ask lots of questions. Ask them, oh, why are you interested in selling? Tell me about the property. How long have you owned it? And be very interested in the person talking. Pay attention. Have good eye contact. You really should read the book by Dale Carnegie, How to Win Friends and Influence People. That book will teach you how to talk to people and will show you the way to interact with people to get the best results. That's going to really give you a lot of help. And you can apply that to all aspects of your life. When you do that, you're going to see overall benefits. So if you focus on the person and try to get to know them, that's going to be the best way for you to be able to, buy a property. As you're talking to them, you can start feeling out what they're thinking, how they're feeling, and you can go from there. Good question. So next question here says, how did you get money for your first apartment? So what I did, I actually worked a job making like $6 to $8 an hour for many years. And then I took that money and I would buy cards and I'd flip the cards. I would comic books. I would flip coins, like silver coins, collectible coins, and just flipped a whole bunch of stuff and added up all that money until I got up. Originally, how I did it, I got up about 20%. So I got up about $32,000 for my first place. And then after that, I realized, you don't need to save up that much money. So then I only put down like $8,000 on my second place. So basically work hard and save your money. That's how I did it. James says, what is the best way to get a bank loan for buying a home? I mean, that is pretty easy. You just have your down payment money saved up. And if you don't continually build that up, build up your credit. So the better credit score you have, the lower the interest rate. And make sure all the money you're making, you're showing it on your taxes. Because if you don't show it on your taxes, it doesn't count. Like, it doesn't matter if you're, say, owning a lawnmower service where you're cutting people's grass and you make $100,000 a year profit. If you don't show that money and you just pocket all the cash, it doesn't matter even if the $100,000 is in your bank account. The bank will not count that income without you putting it on your taxes. So show money on your taxes, build up your credit, get a credit card, something to show you have some credit and have the down payment money. Between those three things, you go to the bank and they'll basically give you a loan. And if it's your first deal, you can go as little as 3.5% down. So you can, get a $200,000 property with as little as like $7,000 down. And then after that, usually for your investment properties, you're going to want like 20 to 30% down. So it's not hard, to be honest with you, to get loans. It's just making sure that you do all those little things, and all those little things add up to be able to get you the loan, and all those little profits add up on each of your units to help you build your wealth. And it just compounds over time. James's question is, bank had denied me this June for a home loan as they weren't satisfied with my business profit. Yes, that is a common thing that happens, and that's really important that you have the right person preparing your taxes that understands how the bank works and understands how the banks are going to view things. Like, for example, a lot of people, what they do in their business is they write off all their expenses on their business. Where, for example, if you bought a tool, let's just use an example. Say your business made $100,000 in profit, and you bought this tool for $30,000. What some businesses will do is they'll write off the tool as an expense. So then it only shows them making $70,000 in profit. But what I would do, because again, I own an accounting firm, I own an insurance agency, so we handle a lot of this stuff for our clients, is that I would take the tool and I would add it as an asset to the company. Then I would depreciate the tool, and you could probably section 179 it, so it means I can write off all $30,000 that year, and it would lower your taxable income from the 100 to 70. So then you would only have to pay taxes on the 70. But because I did it the second way, then the bank will see that it was an asset and then depreciated. The bank will actually give you a loan on $100,000 of income, not the 70. But if you did it the first way, the cheaper, simpler way, they would not add it back. And it won't, because you didn't do it the right way on your taxes. That way, now $30,000 in income is going to allow you to have significant, the ability to get a significantly larger loan to buy a house. So it's really important. Show your money. And if you have a good accountant, he'll be able to find ways to reduce your tax bill. Good question. Any other questions, guys? I think we're going to stay on for about 3 more minutes and answer whatever questions you got before signing off tonight. Great. So James says, do you pay capital gains tax or reinvest? So normally I'll reinvest. And this is the cool thing about real estate, is that when you have income from one piece of property that's been around for a long time, bringing in lots of money, and then you have a loss on this, like for example, bringing in money from my other real estate investments, and I'm bringing a loss from the brand new property that I'm building, and it's not done yet. So I'm going to be able to, and I sold 2 buildings this year, for like 3 buildings actually, and I'm going to show $200,000 in profit. Well, I'm going to be able to take the loss from this new building, and I'm going to depreciate all the assets on it. So I'm going to have about $100,000 loss from this building. And it's going to be able to wash the $200,000 profit minus this $100,000 that I was investing here. So I don't have to pay taxes on half that money, $100,000 left over. If you need me to reword that, I'll reword that, guys. Basically, $200,000 profit here. I invested about $350,000 in this new building. I can probably depreciate about $100,000 off of that this year, and I'll only have to pay tax on $100,000, the difference between the two. But when I go for a loan, they're going to see, oh, wow, he added all these assets and he just depreciated the assets. That's not really a loss. So we're going to add it back. So he really did have $200,000 from his real estate investments, his gains. So we're going to give him the loan on that $200,000. And again, this is $200,000 from my real estate, not counting all my other businesses. So the strategy on your taxes are key for you to continually be able to get loans from the bank, because all these loans from the bank are backed by the government. So the government's going to say, all right, let's compare their income to their tax return. Government wants you to file your taxes. The government are backing these loans. They need to mesh for you to be in a healthy position to continually get more loans. If you look at it that way, you're like, okay, this makes sense. The next point people say, well, oh, this is not fair, that, whatever. They'll say it's not fair for whatever reason. If you think about it, this government is subsidizing these loans. Normally, they would be like 6, 7%, 8% interest. But because they're subsidizing them, they're only 3 to 4% interest. So they're giving you half the price on these loans. It's kind of fair that you have to comply to their rule. You can go and get a loan from private lenders, but then you're going to pay a lot more money. So, when it's their money, it's their rules. Says, how does an LLC work? An LLC, The next question is, how does an LLC work? And basically, an LLC works any way you want it to work. It's a limited liability company, must be set up properly. You must have the right number of partners. There's all these things that must be done. But once you check off all the boxes and everything's done accurately, it basically means this. When the income comes in, the income will flow through the LLC, not through you. There's another way you could do it where it flows through the LLC, then it flows to you. And it's a barrier also can be a barrier for liability, where if it sues the LLC, it doesn't come back to you and go after everything you own. It only goes after what the LLC itself owns. So it's a way for you can shield yourself from liability and to reduce your tax bill if used properly. So the last question for today is it true that don't hold the property for more than 7 years? No, I'm not going to say there's one, it's not a, okay, let me start from the beginning. The average American doesn't keep a property for more than 5 to 7 years. Okay? So, that doesn't mean you shouldn't hold a property for more than 5 to 7 years. Normally, after 5 to 7 years that you've been in an investing game, you very much might sell the property and move on to something bigger because you've grown over time. But it depends on your market, because there's some properties that I bought almost 15 years ago. I still keep them, I still rent them, and there's still upside potential in this market. So I don't want to sell because there's so much more room to growth. The deal matters. That's what matters. All right, guys. Thanks for all the questions. I'll see you guys next time.
Yeah, we're gonna take pictures. I'm gonna put you on